Great, great. So what I'm hearing again and again is I guess you can't make money doing what everyone else is doing. It has to be non-consensus. If you want to beat the benchmark, you have to be high conviction, non-consensus. Where I think we've seen a lot of people say that, but when you look at the portfolios, it's everybody's doing what everybody else is doing. So no, that's great. I know we have an amazing set of speakers here, so I'd like to open it up to the audience here. I'm sure we have a lot of questions from the audience, so please. Okay, there we have. I think we have 3. So there we'll start with Azigami-san, and then is that Trace? Sorry, good. Okay, good. Let me, and then we have
Thank
Dan
you, gentlemen. My name is Suguru. So my question is about growth capital and the venture capital. So I think there's a trend that traditional buyout fund is raising their a growth capital fund, focus on tech area, and venture capital is raising bigger growth fund. So what do you think about the blurring line between private equity fund and venture capitals?
That's a great question.
Well, my reaction to that would be, or my answer to that would be, I think there is a blurred line. The growth capital, for the most part, the growth capital are high growth companies, many of them not turned profitable yet, so they really are falling into the category of later stage venture investments. And quite often the growth capital investors are investing at the last rounds of a venture-backed company from the earlier stages. And so there is a continuum there. I think the challenge for us in an allocator's point of view is to try to figure out where the better risk return and the better risk return value is. And that's not always evident, or at least we're finding it to be a pretty significant challenge. So I think we have ended up erring on the side of harking back to thinking that earlier stage venture is where, if done right, there's a better return profile. And so while we have done a little bit of the growth capital activity in some smaller growth capital managers, we haven't really done very much of that.
And I guess the only thing I'd add is that more of the growth capital firms that we've seen have been larger. And so they've, from a size perspective, it's made them less interesting to us as well.
So I would agree with all of that. For us, we do growth capital only with our early stage managers where it's sort of a combination. And so if you're supporting the firm, it's hard to say I'm going to do your early stage fund and not your growth fund with certain firms. And so there's always that tension. In some, we actually have high conviction in their ability to execute that. But the whole notion of growth capital has evolved over the last 5 or 6 years ago. I mean, 10 years ago, if you told me a venture manager had $1 billion exit, I would thought that was an outstanding exit. Today, that doesn't even register hardly, right? So the notion of what is a success, what's an outcome, what's the potential valuation, where does venture end and growth capital begin, and where do public markets begin, it's been completely distorted over the last 5 years.
Yeah, the one very famous venture fund, they're most intellectually honest, amazing, one of the best performing funds in the last decade. Their CEO said $4 billion is an entry point. Why? When you have $1 billion fund, you can't, to Tim's point, you can't return the fund. So you need to look for the $50 or $100 billion exit. So $4 billion becomes an entry point. And another one of our favorite VC funds, not to be named, they're amazing. And so they said in their annual meeting, they said, we are still doing Series A's. They have $1 billion fund. But they said we are the 4th or 5th round of financing. So there is seed, post-seed, angel. So even though people say they're early stage, now GitHub had a $100 million Series A, so. Anyway, I think we had another question over there, then Dan.
My name's Wen Yi. I actually run Venture Studio in emerging markets in Latin America and in China. So to your point, Stuart, about looking beyond the horizon and looking at other geographies for early stage returns, my reading of the fact that there's a lot more money being invested in venture, but actually the returns are still coming from the top quartile or even the top decile, is that actually putting more money into the system is actually not changing the supply of quality entrepreneurs and teams and companies. And so there's one component which is going to different geography to find some of those inherent supply. Have you been looking at other ways to either change that supply? Like what types of models or investment models, either from an LP standpoint or from a GP, quote unquote, standpoint, actually can change the supply?
I think we had a good discussion yesterday about a couple of new models in the venture world. There's been a pretty significant rise in incubators and platforms and studios and ideation platforms and so forth. So at the very early end, where it's not easy to put large amounts of capital to work, there is, I think, some real change taking place that's very, very interesting. I think the other thing that's sort of driving the profile of all the capital that's come into venture is, and we all know about the trend towards private companies staying private longer, and some of these larger multi-billion-dollar, in quotes, venture funds are all investing at much, much later stages and writing multi-hundred-million-dollar checks and so forth, which really, if characterized as venture, is really a very different style of venture than I suspect you're involved in, and many of us in this room would be attracted to, which would be the earlier stage and the more niche-y, smaller but high multiple opportunity set.
Anyone else want to add to that? Okay, great. I think we also had a question from Dan Card.
Hello, I'm Dan Carter. I'm with Sutter Remco Energy Ventures. It's a corporate sponsored fund. And one other big trend that's been happening over the past few years and is really, I think, continuing is corporates getting into venture investing. And I think it's been changing in the sense that folks that have been coming from other funds have been hired on purpose to be managers of these funds, and it's not just considered kind of dumb money or token money to sort of attract some sort of industry angle anymore. I think we're seeing deals come to us that could easily be funded in Sand Hill Road, but actually preferential to come to the industrial player. And corporate venture being so prevalent, I think I read in an article the other day that even 7-Eleven has a venture fund. So I'm curious, maybe for Tim or for everyone on the panel, how are you seeing the sort of, there was an interesting question about blurring between the large funds on the venture side and the PE side, the blurring of actual smart corporate investing and just pure financial investors?
So it's a good question. If you look like on a historical basis, there's been a pretty consistent ebbing and flowing of corporate venture, right? And so in periods of more robust environments for venture, there was a significant amount of corporate venture, and in periods of sort of the troughs, they tended to retreat pretty significantly. Obviously we're more towards that robust environment at the moment, so it's logical that there's a lot of corporate venture out there. That said, I think the bigger trend, which is a secular trend, is just technology is invading every industry. There is no industry where you can say, well, technology doesn't affect me anymore. And you're just even looking like Google's now going to get reclassified from a tech company to a, I think, telecom or media company or something like that, right? I mean, so I think that companies realize that innovation is critical to their success and future technology. So I don't think that, while there will always be some ebbing and flowing, I think you'll see more permanency around some of that activity this time around, just where we are from the innovation cycle. Long term, that could change, but over the next 10 years, I think you'll see a lot of interest in that area still.
And I was going to say, I think all of that's true, but you're seeing big ag companies investing. Not only, it used to be that they invested in just ag-related stuff, and now it's across the entire spectrum of of technology. You think about or read about the proliferation of investments that Tencent and Alibaba are making in every corner of the world. It just underscores what you said, Tim, is technology anywhere, from anywhere, can be applied almost to every business model in a variety of different ways. And so the larger corporations that are hoping to stay ahead of the crowd really do need to have a window into a great deal of that.
I think maybe one of the most dangerous phrases in the investing business is, it's different this time. But I think for many reasons talked about up here and later on during today's panel, it is different this time. There is, technology is much more pervasive, and it's just going to be a more important part of the whole as we go, regardless of industry.
Yeah, and for the first time, I think we have one more question. Ben, please, and then we have to end it. So, thank you.
Thank you. Ben, founder of Bootstrap Labs, we're a fund focused on AI investing. In our world, when I hear about blurring of borders, it's interesting because I think in AI, things get really clear very fast, and there are tectonic plates out there moving. As global managers, and we talk about geographics, we can talk about ethics. I'm interested in what keeps you up at night. What are the macro things that you think about could happen, impact your portfolio? How are you taking that into consideration?
I would say pretty, the 25 words or less version to that answer would be investing outside of geographies or legal structures that we probably don't understand as well as we might home turf. So, we think about this when we go to virtually any foreign country to invest, and I would say maybe 40% or 45% of our portfolio is outside U.S., but our investments in China or Brazil or really any of the emerging markets, even in the European, for example, where the legal structures are different and the ethics and the culture around ethics can be very different. I think that's the thing that surprises me the most. It's not, can we find good managers who might be providing exceptional alpha in an asset class? It's all the other stuff that culturally that surrounds them that keeps me awake.
And for me, the biggest part of our portfolio is real estate, and most of it's Hawaii. So I've never thought about North Korean missile risk before, or tsunami risk, or volcano risk. But aside from that, it's geopolitics. Probably just, does the world remain a relatively safe and calm place to invest, or does it not? And what the permutations from that might be.
I would say every portfolio, you have to take risks somewhere to earn your excess return. So every institution is going to have their various choice. For you, it's real estate. For us, it's venture or some other things, right? So I have specific things like that are in my control in my portfolio that I worry about. And then mostly it's the things that are out of my control, which is the geopolitics and things of that nature.
Great. Well, thank you so much for this amazing panel.